All right. So welcome to part 2 of our Forex basic tutorial, where we're going to go through pairs, pips, and lot size. Once again, my name is Steve Nurre with NurreFX, and let's get this ball rolling, going into some more subject matters and trying to get a good footing for you and a good solid foundation in the basics, so that you can get so you don't get tripped up over some of the basic terminology and just a little bit of the different view that Forex gives you can sometimes be a stumbling block for people when they first start trading this market. So let's first go through an anatomy of a currency pair. As you could see earlier in the previous tutorial, we do not deal in just one individual investment. In this case, when we're trading in the Forex market, we're trading the Euro-US dollar pair. Everything works in pairs in the Forex market. You're always looking at one country's currency versus another. An easy way to look at the Forex market is what side of the pair each individual currency is on is an easy way to distinguish between what is actually occurring with the exchange rate. The way you look at a currency pair is the currency that's to the left side of the pair, in this case the euro, is what we call the base currency. The currency that's to the right, in this case the US dollar, is called the quote or counter currency. So whenever you're looking at these pairs, an easy, first thing you need to learn is the currency to the left, when I'm looking at the euro dollar, is the base. The currency to the right is the quote. Everything comes down to base versus quote currency, because that tells you everything about what's happening with the exchange rate. It tells you everything about what's occurring on the actual charts and on the and especially when it comes to strength and weakness in the market between the two currencies. So let's delve a little bit further into this, and let's take a look at a Forex quote screen, and let's take our Euro-US dollar pair as an example, since it is the most actively traded in the Forex markets. So looking at the Euro-US dollar pair, you can see which one's the base, the euro, which one's the quote, the dollar. Now if we were to go a little bit further down the line here, you can see that in some of these pairs, the dollar's the base currency also. So like in the dollar Swiss pair, this is the dollar Swiss franc pair. Which currency is the base? The dollar. Which one's the quote? The Swiss. Here's our dollar yen right underneath that. In that case, the dollar is the base currency, the yen is the quote currency, and so on and so forth as we go down. So being able to distinguish between what the base and quote currency is tells you everything about what's happening on this right-hand side as far as the exchange rate goes. So let's use our Euro-US dollar pair as an example. So here's our euro. The base currency is always equal to 1 unit. Okay, 1 unit of currency. The quote currency is what the exchange rate on the right hand side of this screen, on the right hand side between the bid and ask price, is being quoted in. So in this case, when you're looking at the Euro-US dollar pair and you see the asking price of 1.09700, that means it's taking 1.0970 US dollars to exchange for 1 euro. So that's an easy way to look at the Forex market, is knowing what the base and the quote is tells you everything about that exchange rate. The bid and ask price is essentially where the bid price being where we can currently sell a currency pair, and with the ask price being where we can currently buy a currency pair, and we'll get into that a little bit later. But those numbers that you see in that bid and ask price, it's important to know how they're being quoted. So once again, in this case, euro is the base currency, 1 unit, and the quote currency, that asking price of 1.09700, because the dollar is the quote currency, it's telling you that exchange rate is telling you how many dollars it's taking to exchange for 1 euro. Very important concept to understand, especially when we're looking at charts. In fact, let's go to a chart here, and I can give you a quick example of this. In fact, we'll zoom in a little bit here. Take this over. One of the reasons, this is a chart on the Euro-US dollar pair, and you can see that this chart is actually plotting that exchange rate of how many dollars it takes to exchange for a euro. Reason why it's important to know the difference between the base and the quote currency is what direction, when this chart is going down, what direction is the exchange rate going? It's going down. Now when you look at this, one of the confusing things for Forex traders is the fact that you'll often see people, whether it be CNBC or your local financial news network, that'll pull up a chart on the Euro-US dollar pair, and you'll see it going down like this. And what they'll be saying on the news gets people really confused, because they'll say the dollar is going up today. The dollar is going straight up. But you'll look at a chart, and they'll pull up a chart such as this one, and you'll see the dollar, you'll see the Euro-US dollar pair, you'll see the chart going straight down, and it's hard to distinguish because people will say, wait, this guy's telling me the dollar's going straight up, and I'm looking at a chart that's going straight down. Well, think about it this way. When this exchange rate is going down, it means it's taking less dollars to exchange for a euro, okay? Because this exchange rate is telling you how many dollars it takes to exchange for 1 euro, when this is going down, it is taking less and less dollars to exchange for 1 euro. If it's taking less of our country's currency to exchange for just 1 unit of theirs, what country's currency is getting stronger, the euro or the dollar? The dollar, right? Because it's taking less and less dollars to exchange for a euro. On the flip side of that, when the market goes up, that means the exchange rate's going up. It means it's taking more and more dollars to exchange for a euro. So, sometimes when we're analyzing currency pairs, that's one of the biggest stumbling blocks for newest students, is because they can't get the direction right of what's getting strong and what's getting weak, because they have a hard time of distinguishing between the base and the quote currency. An easy way to look at it is the trend. The base currency is always reflected in the trend. So if we're looking at the Euro-US dollar pair, if this is coming down, the base is getting weaker, and since you're looking at how the dollar compares to the euro is getting weaker, the dollar is getting stronger. When it's going up, the base currency is getting stronger, quote currency is getting weaker. So the trend is often reflected the base currency is reflected in the trend. Now, as far as those exchange rates and the lot size, we'll go through pips, fractional pips, and lot size, which is also a big benefit of trading the Forex market, especially when it comes to controlling risk. We often have a running joke in my classes because people often ask me, you've probably heard of pips if you've traded Forex before. People often ask me, what does PIP stand for? And the running joke that I have is, depending on who you ask, it can sometimes be called percentage and point, price interest point. But my standard joke that I tell students is they call them pips because Gladys Knight invented the Forex. Ba-dum-bum-bum. So pip, fractional pips, and what is a lot? So let's go through pips first. What is a pip? It's the smallest price increment a given exchange rate can move. When you look at all these Forex pairs, you'll see that in this case, like the Euro-US dollar pair, which let's look at that 1.09700 again. It's not being quoted it's not being quoted to the nearest penny. It's not telling you $1.09 per euro. It's going out to 1/100th, 1/1000th of a penny. And those last two columns, when they move up and down, is what's considered a 1 point or 1 pip or fractional point or fractional pip movement in the market. So when people ask why you're trading the Forex, oftentimes they'll think it's crazy because of the fact that you may only see the Euro-US dollar exchange rate move by 1 penny per day, and people have a hard time understanding that. Well, you're not making money for a 1 penny movement in the market. You're making money off of 1/100th of a penny movement in the market, off of 1/1000th of a penny movement in the market. And as we always say, they say the penny has no value anymore, but we're making money off fractional amounts of pennies as they move up and down by including leverage in our trading. So what constitutes a full pip or a full point movement in the market? The majority of currency pairs, and the reason why we go through this in the way that we are, the majority of currency pairs are going to be carried out 5 decimal places. Some of you, depending on where you live, your Forex pairs may only be carried out 4 decimal places. The Euro-US dollar pair in this case, the 4th decimal place, in this case the 8 that you see right there, every time that moves up and down, let's say that 8 moves to a 9 or down to a 7, that's considered 1 pip or 1 point of movement in the market. Which back in the day, in the early 2000s, a lot of Forex brokers would only carry their quotes out to that 4th decimal place, to where you're making and losing just 1 pip or point in the market. However, most of the time now worldwide, you're going to see that the exchange rates are now carried out with a lot of the pairs to a 5th decimal place. This is called a fractional pip or a fractional point, and it's equivalent to 0.1 points in the market. So when that 5th decimal place moves up and down, that's considered 0.1 point or 0.1 pip movement in the market. Just so I understand that you're getting this, to understand the way the pips move, if the euro dollar were to move from 1.09683 to 1.09884, how many pips did that move? So if you look, how many pips did it move? So if this is 1 pip, that would be 10 pips. This would be 100 pips. This would be 1,000 pips. This would be 10,000 pips. So 1.09683 to 1.09884, if you subtract those out, it would come to 0.00201. If you subtracted the higher rate from the lower rate, it would come to 0.00201. That's equivalent to a 20.1 movement, pip movement in the market. 20.1 pips is the amount that it moved. So whenever the last decimal place moves, or the second last decimal place, that is where you're making your money in the foreign exchange markets. And like I said, they don't just move a penny a day. If it moves a penny a day, you've made 100 pips or 100 points. The only exception to this, and this is actually an older quote that I have on here, is the yen pairs. They're not the only exception, because there are some exotic and other what we call minor currencies that are traded out there. But the one big glaring exception as far as the currencies that we trade are going to be the yen pairs. The yen pairs on the brokerage platforms are only carried out 3 decimal places. In this case, the second to last decimal place would be a full pip or point of movement, and the last decimal place would be a fractional pip. Again, most brokers, the last decimal place, most brokers are going to quote to a 3rd decimal place on the yen pairs, to a 5th decimal place on the majority of other pairs like euro, US dollar, pound dollar. So when you are looking at dollar yen, though, you'll see that it's only carried out 3 decimal places, and it's just because of the sheer amount of yen that it takes to exchange for 1 unit of currency around the world. It's just quoted in a different way. So with the yen pairs, in this case, if the dollar yen were to move to from 81.753 to 81.966, how many pips of movement, how many points of movement would that be? Well, in this case, that would be 21.3 pips. If you take the higher exchange rate minus the lower, what it would look like is 0.213. In that case, that would be 21.3 pips, because this second decimal place would be considered 1 pip of movement, and the 3rd decimal place being a fractional pip. So as these exchange rates move up and down, once again, you're making your money off of a 1/100th of a penny movement or 1/1000th of a penny movement in the market. And remember, on this dollar yen, this is telling you how much yen it's taking to exchange for 1 US dollar. Remember, base versus quote. So let's think about that for a second. If the dollar yen were to move from 81.753 to 81.966, what currency got stronger in this move, the dollar or the yen? Well, if this exchange rate went up, correct? If this exchange rate went up, it means it's taking more yen to exchange for $1. So that means the dollar's gotten stronger and the yen gets weaker as this exchange rate moves up. Remember, base versus quote currency. Now, another big benefit of the Forex market is your ability to be able to define your risk based on lot size. A lot of different like options trading, futures trading have standardized contracts where you have to deal in just one specific amount that you're controlling when you buy or sell. But amount that you control on a currency pair, you can actually change and customize based on your risk tolerance levels. And these are called standard lots, mini lots, and what we call micro lots, whereas some people call them micro mini lots, which depending on of where you're from, I just consider them micro lots. And what size lots that you trade tell you everything about how much risk you have in the market and how much currency you're controlling when you buy or sell a pair. So a standard lot controls 100,000 currency units per lot traded. So if you buy one standard lot of the Euro US dollar, just like in our first example from our first tutorial, you are exchanging enough dollars into one to control 100,000 euros. So that would be a standard lot. If you remember from our first tutorial, we bought two standard lots essentially of the Euro US dollar on the Lamborghini transaction. That was 200,000 euros. Obviously, when you're doing a standard lot trade, your value, the amount that you're making as the exchange rates move up and down, is substantial. But if you don't want to deal in that amount of risk, you can also trade what we call mini lots. When you buy or sell a mini lot, that controls 10,000 units of currency per lot traded. So if I buy one mini lot on the Euro US dollar, that means I'm taking control of 10,000 euros, which is going to lower my risk. It means that I'm not making as much, and it means I'm making smaller amounts as the currency pairs fluctuate up and down. And then we have what are called micro lots, which control 1,000 currency units per lot traded. When buying one micro lot of the Euro US dollar, that means I'm taking control of 1,000 euros. And what do you think is going to happen here? By having the ability to control how many lots I'm trading, that means that I'm going to be able to customize my risk. It means I'm going to be able to lower my risk in my trading depending on what size lot that I control. It's a big benefit because if you're new to Forex trading, you don't have to go in and be risking, $10 per pip like on a standard lot. You can go in and actually just risk 10 cents per pip as each point moves up and down. Let me go in and actually I'll show you what this looks like on a trading platform so that you can get it. Let's use since we've been on the Euro US dollar, let's use the Euro US dollar as an example here. Let's go into our trading screen, and I'll right click here and I'll go to new order. And let's say I want to trade one standard lot. So that would be 1.00 on the Euro US dollar pair. So I'll click on buy. And what I've done there is I've exchanged enough dollars at this exchange rate of 1.10190, enough dollars to control 100,000 euros. Now, let's say I wanted a little bit less risk on my account. I'll go to new order and I'll put in 0.10 here under volume. Now if I click on buy, I'm going to exchange enough dollars to control 10,000 euros. That would be considered a mini lot. In a standardized Forex account, that would be considered a mini lot. And click buy by market. Well, let's say I had I really wanted to make my risk as the least amount of risk as possible on a trade. Let's say I only have $500 in my account and I don't want to over leverage, if you will. Well, I can go in here, I can click right click on the screen, go to new order, and I can put in 0.01. Now if I click on 0.01 and click buy by market, exchange enough dollars to only control 1,000 units of currency. And of course you can do, I could do 0.02 or 0.03. So you can kind of customize the amount of currency that you're controlling in the market, and thus you can kind of customize your risk, if you will. And risk management is a huge part of trading this market. Now if I go into view all three of those trades, what you'll be able to see down here throughout these three trades is I have €1 US dollar on, and you can see my profit. I'm actually up only 0.09 pips on this, so I'm up like $9. All right, that was the first trade that we put in. That's only 0.09. That's 9 fractional pips, because each pip is worth $10 on that standard lot of 1. On this one right in here at 0.10, you can see I'm down 7 fractional pips, but I'm only down 70 cents. And so if I was down that same amount up here, I'd be down $7. Now down in here on this Euro US dollar pair where it says 0.01, I got in on that 3 different prices here, by the way. On this one, I'm down 3 fractional pips. But you can see on this one that I'm only down like 30 cents. So I'm sorry, I'm down 3 pips, 3 total pips. I apologize. I'm down 3 whole pips. On this one, I'm up 9 fractional pips. I'm down 7 fractional pips, but I'm down 3 entire pips on this one, 3 points. And I'm only down 30 cents. And why? Because on this one, I'm making or losing $10 per pip. On this one, I'm risking or I'm making or losing $1 per pip. And down here, I'm making or losing 10 cents per pip. And that can, that's really how you can customize and manage your risk much better. Is if you don't want to put as much risk into the Forex market, just trade less lot sizes. Just trade lower lots. You don't have to go in and control 100,000 units of currency every time you go in and trade. And the amount of margin, which we'll be talking about in later sessions, will change also. So our next tutorial, now that we know a little bit about exchange rates to base in the quote currency, now that we know what a pip is, what constitutes 1 pip of movement in the market, and now that we know a little bit about lot size of how many units of currency that we're controlling when we buy or sell, the next step is actually being able to calculate our pip value of how much are we making or losing total. And it can change based on what currency pair you're trading, whether it be a direct rate, indirect rate, or cross rate transaction. So that'll be our next tutorial. I want to thank you for watching, and I look forward to seeing you in our next web tutorial. Thanks for coming in.